57,000 jobs. That's all the American economy added last month. Wall Street expected 110,000. They got half. Unemployment didn't rise. It fell to 4.2%. Not because more people found work, because people stopped looking. Within 48 hours, gold broke past $4,200 an ounce. A 7-month low, erased in a matter of days. Somewhere between a weak jobs report and a spike in gold, a story is unfolding right now. And most people watching the news are looking at the wrong number entirely. Quick note before we go further. This video is for educational purposes only. This is not financial advice. Nothing here is a recommendation to buy, sell, or hold any asset. Now, let's actually break this down. Welcome to Capital Clarity, where we explain investing concepts in a simple way. Think of the U.S. economy like a large ship crossing the ocean. Most passengers never see the engine room. They just feel the ship speeding up or slowing down. The jobs report is the engine room gauge. It tells economists, and by extension, investors everywhere, whether the engine is running hot, running cool, or sputtering. When that gauge shows fewer jobs than expected, it doesn't mean the ship is sinking. It means the engine might be cooling faster than the crew planned for. And that single signal ripples through every other instrument on the ship, including the price of gold, thousands of miles away from any factory floor or hiring office. Here's the mechanism, step by step. Step 1. A weak jobs report suggests the economy is slowing down. Step 2. When the economy slows, central banks, in this case, the Federal Reserve, become less likely to raise interest rates. Some analysts even start pricing in the opposite, future rate cuts. Step 3. Lower interest rates make it cheaper to hold assets that don't pay interest, like gold. When rates are high, holding gold means giving up the interest you could have earned elsewhere. When rates are expected to fall, that opportunity cost shrinks. Gold becomes relatively more attractive. Step 4. At the same time, a weaker U.S. economy tends to weaken the U.S. dollar. Since gold is priced in dollars globally, a weaker dollar mathematically pushes gold prices higher, even before you factor in investor psychology. That's the how. 4 mechanical steps, and you already understand more about gold pricing than most casual investors ever bother learning. Now here's the why, the psychology underneath. This is the part that confuses people the most. Bad economic news often makes certain assets go up. It feels backwards. If the jobs market is weakening, shouldn't everything just fall? Not exactly. Markets don't move on good news or bad news. They move on surprises, the gap between what was expected and what actually happened. Wall Street had priced in 110,000 new jobs. Getting 57,000 wasn't just disappointing. It was a shock relative to expectations. And shocks change behavior fast. Within days, futures markets slashed the probability of a September rate hike from roughly 67% down to under 50%. That shift in expectation is what actually moved gold. Not the jobs number itself, but what the jobs number implied about the Fed's next move. This is the same reason central banks around the world have quietly been adding gold to their reserves, tens of tons in recent months alone. It's not a conspiracy. It's simple portfolio logic. When the world's reserve currency shows signs of strain and interest rate paths grow uncertain, gold becomes the boring, reliable seatbelt in an unpredictable car. Let's make this concrete with 2 people. We'll call them Sarah and Marcus. Sarah reads the jobs report the morning it comes out. She sees gold has jumped. She panics, sells a chunk of her stock portfolio, and moves everything into gold, convinced a recession is imminent. 2 weeks later, the labor market data gets revised slightly upward. The panic cools, and gold pulls back from its highs. Sarah locked in her move at the peak of the fear cycle, buying gold expensive, selling stocks cheap. Marcus reads the exact same headline. He does nothing dramatic. He continues his regular monthly investment contributions, same as always. A portion into a broad index fund, a smaller portion into a diversified commodities allocation he set up months ago. Long before this headline existed, he doesn't try to predict the next data point. He just keeps showing up. Historically, this is the pattern that plays out again and again. Investors who react to single headlines tend to buy assets after the move has already happened and sell during the worst moment of a dip. Investors who maintain a long-term diversified strategy simply ride through the noise. Neither Sarah nor Marcus is unusual. They represent two instincts every single investor has felt at some point. The difference is which instinct they chose to act on. This isn't about being right or wrong on any single trade. It's about which behavior compounds better over 10 years versus which behavior feels better for 10 minutes. Here's what most headlines miss entirely. The story isn't the U.S. economy is collapsing. Growth forecasts from the IMF and World Bank for 2026 still point to global growth in the range of 2.7% to 3.3%. Slower than we'd like, but nowhere near collapse. The real story is that markets had priced in a very specific, very confident narrative that the Fed would need to keep hiking rates well into the year. And one data point cracked that confidence. Gold at $4,200 isn't a fear indicator about tomorrow. It's a real-time poll of how confident the market is in its own assumptions about interest rates. And right now, that confidence is shaking. That's the part worth remembering long after this specific jobs report is forgotten and replaced by the next one next month and the one after that. Markets don't panic over bad news. They panic over surprises. The headline will always change. The mechanism behind it, expectations meeting reality, rarely does. If you understand that one idea, you'll understand almost every dramatic market move you see in the news for the rest of your investing life. This is not financial advice, and no single data point should ever be the reason you overhaul your entire strategy. But understanding why markets move the way they do, that's something worth carrying with you into every headline you read from here on out. If this helped make sense of a confusing week in the markets, hit like, subscribe for more breakdowns like this one, and drop a comment. Are you Team Sarah or Team Marcus? Thanks for watching. See you very soon.